If you've been watching my videos for a while, you know that I love global index funds. In fact, I stick to what I say and I only have one global stock fund in my portfolio. So in this video, we'll go over what to consider when picking a good fund for the long term. And if you stay for the end of the video, I'll give you my opinion about which funds are best to buy and hold forever. And I will also share which fund I invest in. Now, when we talk about long-term investing, we mean 15 to 20 years or even more. It makes sense, therefore, to have a lot of stocks in our portfolio because over such long periods, stocks tend to outperform almost any other investment. Over the last 150 years, stocks have generated 9.1% per year on average, whereas bonds have generated just 4.6%. Also, if we look at gold, that's much lower, just 3.1%, which is just above the long-term inflation rate of 2.1%. So how do you generate this return? Well, in my opinion, the most cost-effective and simple way is by buying a global stock fund, which is very diversified. Approximately 60% of it will be invested in US stocks, and you'll also get the extra diversification of having other countries in your portfolio. Now, there is such a growing competition in this space that these global stock funds offered by various providers are almost identical. For example, here you can see I've got 3 funds. In this case, all of these funds track the same index, the MSCI All Country World Index. But what if you mix up your global funds so that you don't track the same index? So MSCI ACWI, the All Country World, is one global index, but another one might be the FTSE All World. And the very popular global fund that tracks the FTSE All World Index is Vanguard's VWRP, which reinvests dividends automatically back into the fund. And if I plot that one on the chart here, you can already start to see that returns will differ. This chart also shows how similar these funds are. When one falls, they all fall. And when one rises, they all rise too. Sure, there are some differences, but over the 5 years since 2019, they all returned between 11 and 14%. So not a lot to choose between them, and honestly, I'd be happy with any of these. Therefore, with so much competition, there are only a few things that can differentiate these funds. So what should we look for in a global equity fund? One consideration is whether to include only developed markets or to also include emerging markets. Usually the split is roughly 90% to 10%. However, if you're investing for the long term, including emerging markets might add a bit of extra return. Another consideration is whether to buy an accumulation fund or an income fund. Accumulation funds automatically reinvest dividends back into the fund, so the price includes those dividends and gradually increases in value over time, eliminating the need for you to reinvest the money. On the other hand, income funds pay dividends directly into your investment account, and you can choose whether to reinvest that money or not. These are usually preferred by retirees. Personally, I prefer accumulation funds because there is less effort involved in reinvesting the dividends. Another thing to consider is whether it's an exchange-traded fund, ETF, or a regular mutual fund, also known as an open-ended investment company in the UK. Some low-cost investment platforms in the UK only allow you to trade and hold ETFs, which can limit your options for global funds. The last consideration is the currency in which the fund trades. If it's in US dollars, as many global funds are, you'll need to convert your money into dollars on your investment platform, and the fees for that conversion are often not very competitive. A more cost-effective way is to have the fund manager handle the currency conversion. If the fund trades in pounds, the manager will convert it into US dollars at a much lower cost than we can. Therefore, choosing a fund that trades on the London Stock Exchange in pounds is often a sensible option. However, these funds are often slightly more expensive, so keep that in mind. Now, as we saw earlier, the returns on these global stock funds are very similar. But to me, another important thing to consider is their price, meaning that it's often simply a matter of fee to choose which fund you like best. So here are the 10 funds with the lowest fees that I found, and you'll notice that they all vary in some aspect, whether they're income or accumulation, whether they're ETFs or regular funds, and also the global coverage that they offer. The cheapest ones tend to be those that track just developed markets. That's because those markets tend to be more liquid, and the bid-offer spread, the difference between the buying and selling price for their stocks, tends to be very similar. So because you can trade the underlying stocks cheaply, the fund manager will pass on that lower fee to you. Including emerging markets usually increases the fee because those markets tend to be less liquid. So the top 5 cheapest funds are the ones which are all from developed markets. The 6th one excludes the UK, which some people might want, some people might not. But in my opinion, it's not particularly important because the UK only makes up 4% of global equity anyway. The lowest fee fund, which includes emerging markets on this list, is actually not an exchange traded fund. It's the HSBC FTSE All World Tracker. Now, I mentioned earlier that I only have one global stock fund in my portfolio, which is the Vanguard Global All Cap Index Fund, but it didn't make it onto this list. The reason for this is that I initially bought this fund when I began investing years ago on the Vanguard platform, and it was the most appealing option available at the time. As you may know, Vanguard only trades their own funds, unlike brokers like Trading212, where you can purchase funds from various providers. So I've stuck with this fund out of convenience because I just can't be bothered to transfer my ISA to a new provider and then buy a different fund there. Sure, I may be losing some money in fees over time, but I do like this fund as it includes emerging markets as well as smaller stocks that have the potential to outperform in the long run. Essentially, I'm paying a slightly higher fee for the potential of higher rewards, and I'm fully comfortable with that. Now, your choice of fund will also be restricted if you are on an ETF-only platform, and that would include platforms such as InvestEngine or Trading212 here in the UK. In this case, as you can see, that reduces the list of our funds to only 5 cheap funds. So I think the best choice of fund here depends on what kind of platform you're on. If you're restricted by Vanguard, then you'd probably go for the fund I went for, or for something like VWRP, which is a popular choice among investors. But if you use an ETF-only platform, this Invesco FTSE All World Tracker with the ticker symbol FWRG is definitely one to consider. It's an accumulation fund, it includes emerging markets, and it trades in pounds. It's essentially VWRP offered by Vanguard, but much cheaper. Now, this was only issued in June of 2023. So there isn't much data available on it, but you know which index is tracking, so you know what returns it's going to give you. One thing to be aware of with this one is that it's traded in 2 versions. If you buy the one with the ticker FWRA, it will trade in US dollars. That means you'll have to pay for the currency conversion. If you trade the version called FWRG, that trades in pounds. And that means that Invesco will do the currency conversion for you more cheaply. If you don't mind excluding emerging markets, you can get an even cheaper ETF, which is the Lixer Core MSCI World Fund, ticker symbol LCWL. You could also consider the LNG Global Equity Fund, which trades with the ticker symbol LGGG. This one is also cheap, but it doesn't include emerging markets. Or if you do want to exclude emerging markets, you might prefer something like PRIW, which is super cheap, but it's an income fund, meaning that you're going to have to reinvest the dividends. If you're not on an ETF-only platform and you're not on Vanguard, then I think probably one of the best accumulation funds, which is truly global, is the HSBC FTSE All World Fund Tracker. It's also an accumulation fund, meaning that you don't have to reinvest the dividends. So I think that's definitely a good choice. Therefore, it really depends on which platform you're on, and then taking into account the other factors we talked about, whether you want the income to be reinvested, whether you want to include emerging markets, and so on. I hope this has helped you decide which fund makes sense for you and which one might be best to stick with forever. Personally, I believe that limiting my fund choice to just one has been one of the best decisions I've made. It allows me to avoid tinkering with my investments and do potential harm to my portfolio by not having to worry about asset allocation, regional allocation, or rebalancing. It simply made my life a lot easier. But now the problem is that the outlook for the stock market in the next 5 to 10 years isn't looking too good. In fact, Vanguard thinks that we will all make a lot less money in the stock market moving forward. So check out this video next to find out why and what it actually means for you. See you there.